Hi, this is Randy Finney with the right side of the chart, and this is a mid-session update for Monday, June 3rd, 2024. It is 1:57 p.m. Eastern Time as I'm starting the video, and here's what we'll do in the following order. We'll go over the equity markets. That's the major indexes. I'll hit them all. We'll go over the large, mid, and small caps on this one. Just briefly, brief overview. Then we'll roll into bonds. I want to talk about treasuries a little bit. Of course, the interest rate thing, which is important. Something I'm noticing today with junk bonds, lower grade bonds, as well as investment grade corps. Maybe mention when I get in the indexes, there's a couple little mini flash crashes today. Nothing big. Oh, let me add to that. Yeah, because this market's just gone wild. We'll talk about AMC and GameStop and a lot of buzz there today on those. Quick update on the semis, and then the usual commodities I've been focused on lately: crude, nat gas, and wheat. So just be brief on all of those. So let me start out here. One of the subscribers asked if there's any change on the monthly charts and if I'd include those in the next video. There is no change. He asked how the monthly candles in May closed, and you can see there it's really a non-event and SPY. We still have that big negative divergence, again, rarely seen. You get them every few years, and as I scroll back here again, you can see all the performance of the S&P 500 following these divergent highs, double-digit drops, bear markets, that's, I'm reading them out, 20%, 23, roughly 51, 57, 22, 8, that's 15, 20, 36 when COVID came, all off divergent highs. That was a roughly, did I measure it out there? Oh yeah, I measured out as we started to go. I never updated that. So that was the bear drop in bear trend, whatever you want to call it, in 2022. But this, we only had, as I noted back then, we didn't have what I call full negative divergence. We only had one indicator, the RSI, and it still gave us that, what we had in 2022. Now we have clean negative divergence on both indicators, just waiting for that bearish PPO crossover. So as far as the candles go, I can't deduce any useful info there on SPY or QQQ. I'll just hit on that real quick. QQQ, there's your candle for the month. Really non-event as far as candlestick analysis goes. Same story. You have the big divergence now on the PPO and RSI. The drops in the tech heavy Nasdaq 100 are usually bigger than what you get here. These weren't measured off divergent highs. These were right here. That was no, actually we didn't. We had on the S&P. So you rarely see them on the Nasdaq 100. There was one right there, 26% drop. That was I believe that was a little flash crash, or the Q4 2018 drop back then, 31% drop when COVID hit roughly. And so there it is. So here's your uptrend line. This is what you want to watch on the monthly, a solid close below that uptrend line. And then that dashed blue line is a 20-month exponential moving average. Does a really good job of defining bull and bear trends. So small caps that I cover off in IWM, well, nothing's changed. They peaked back in 2021 and are still well off those highs. You had a little trading range there before they topped, and they did have a divergent high back then. You had the negative divergence that was put in. You don't have any negative divergence now because you can't, because we haven't even equaled. We have to equal or make a new high there. So right now we're in this trading range at resistance, about 210, which was the bottom of the range back here. And so there's your small caps. There's an uptrend line, which we'll probably visit sometime in the near future. And then the tweens. Between the large and small caps, you have a universe, a lot of stocks out there in the mid caps. And so this is MDY, the S&P 500 mid cap sector ETF. And, sometimes I got to add annotations to these charts. You had the divergent highs there, all double-digit drops off those divergent highs. They're not all marked. I don't follow this chart on a monthly basis very often, but I just added the lines for you. Sometimes they kind of disappear. I call it line shift. I don't know, with this platform, a lot of my lines sometimes just go away. And anywho, that's it. So you have a big negative divergence. And very important, I say this often, this is a monthly time frame. The candles you only know what the candle is going to be at the end of the month. So now we won't know to the end of June, and that's all that really matters, how you close a month. But these divergences again are fairly accurate predictor. They're indicators that show momentum's changing and trend reversal is likely. And these trend reversals, again, are typically measured well into the double digits. That last one we had was when COVID hit. Right before COVID hit, we had the divergent high, and mid caps fell about 43% or so right there. Time before that was back there in 2015, and they dropped 21%. This is the biggest divergence that I've seen in history of charting the mid caps. Only thing close was back when the dot-com bubble burst back here, and you had about a 33% drop. Oh, and then of course the Great Recession right there, from the highs to lows, mid caps fell 54%, and that was it. And you only had that on the PPO. The RSI had a slightly higher high. So there it is. So again, the takeaway is there's no hard set rule, but typically the bigger divergence, the bigger the ensuing trend change. And so it just takes time for these things to play out. And then with that, sometimes they don't play out. Sometimes you take the divergence out and you keep going and it's burned through. And that happens when this previous high is taken out and that previous high is taken out. But as of now, nothing's changed. That divergence has been building for over a year now, a couple of years actually. So anyway, we'll look for any updates there on the monthly. And like I just wanted to follow up to that request. There's really no useful information I can take from the monthly charts this last month. And stepping it down, when I go to the weeklies, we still have the divergence on the indexes, all of them, I believe. This is the daily chart. That was a divergent high. We made an equal high, a roughly equal high in prices, and then still made lower low in the indicators. That's still negative divergence. That's just DH1, followed by the first correction or shot off the bow. There was I always say divergence is not a sell signal. What is a sell signal is a break of trend line. So there was a trend line break. And there was a short trade to be made right there. It came down to this reaction high right here. Little rally, put in an equal high, and moving lower so far. That equal high was a divergent high. And then this is the new trend line to watch right there. And then you still have price support about 531 and change, and that should take us down there. So that's the mid caps. I could do the same thing on QQQ and SPY. Most important to me, and I just want to say this, I mentioned it last week, I'm shifting a bit back into swing trading mode. Today I've been struggling to get a video out to you guys, just not seeing a whole lot that's exciting me or anything really super significant to note. But I figured I'm going to get a video out to you because I'll be at my desk tomorrow, but at some point, and I don't know if I'm going to cut out before the close or not, I'm going to drive down. I have to drive over to Miami. I mentioned to you guys, I'm leaving the country in less than a week. It was a week. A week today. I'm sorry. But I'll be actually leaving town before that. We're flying in and out of Miami. We're going to Italy for 10 days. I'll do my best to have it be a working vacation. But as I mentioned, didn't learn until just very recently after our trip was planned. You have to have 3 months on the end of your return date on your passport to go in and out of Italy. So I have to do an emergency passport request. You have to wait in a 2-week window, and there's only one place in the entire state of Florida to do it, and that's Miami. So sorry, guys. I gotta. That will be. It's Wednesday morning is my appointment there. And then I'll be coming back home sometime Wednesday. I have family there, so I'm going to go down the night before. I just want to let you know, I'll get some things out to you tomorrow. Then depending on when I'm cutting out, I'll be dark the rest of Tuesday. And at minimum, the first half of Monday, possibly a little later if I get looped into visiting family. Again, I was just down there. So that's my schedule. And it's also like I said, I'm here today, and there's not a lot that's exciting me for active trade. I'm going to go over the shorter term charts in a second. I'm going to cover the different things that I mentioned. But I do want to reiterate what's keeping me in, kind of swing trade mode is, my plan. I was clear on my trading plan back here on the previous. It was still, again, same trade or a new trade, however you want to call it. For me, it's a different trade because I covered there. It was very, very clear all along my trading plan. Cover, reverse, game along, scale back into shorts up to, but not above do not add above 433. And if we took out the downtrend line, which we did, stop out because we're probably going to run to new highs, which we did. And then we recently put in these bearish engulfing candles. So that to me is a new swing trade. Again, if you're looking, longer term for these targets down here, or even the longer term I have on the weekly, it could be the same trade. You're only a marginal, just a couple percentage points above where we started, back then shorting it here. So hopefully that makes sense. Your trading plan is not going to be my trading plan or the guy and gal next to you. Everybody is different. What I do is I'll tell you what I'm doing, and I also strive to, in addition to providing just pure technical analysis, give you the levels, to watch, developments to watch for, and be you bull or bear right now, levels that you can go long if you're bullish, or levels that you want to wait to short if you're bearish. There's an uptrend line. Remember, that's the one we hit on Friday right there. Bounced that hard intraday reversal into the close. We hit that was on the 15 or 60 minute chart. And so now that is, to me, probably the most significant level. It's also, look, if I turn the lines off here, it's that 50-day moving average that tends to act as support during uptrends. And once you break it, as you did there, it's resistance. And you rally back, shorted, got rejected, and they took it back there, and they just bought it again there. So it's one of the key moving averages, a little faster, obviously, than the 200 days, which I'm still targeting for a swing trade down to. So again, turning back on the lines, we hit pretty much the intersecting 50-day moving average in the uptrend line last week. So now those are the ones you want to see go. And there was price support here about 442.58. Worth noting as well, we now have that. We had it on Friday. I think I mentioned it. The bearish PPO crossover. That's and it helps to confirm what was potential divergence at that point. Potential when the indicators are moving up, but haven't made a cross. I like to see that bearish crossover. It effectively puts in a lower high on the indicators. And so there it is. So that's a additional check mark. And so again, I'm pressing it as long as we stay well within those, under those bearish engulfing candles. Like I said, I wouldn't be shocked to see a little brief pop, a little stop clearing move. It's the nature of this market. I mean, speaking of that, we just jump forward to Friday. This was Friday. Remember on the 15-minute chart, I think it was, we hit that trend line, bounced. And then what they did is there was a divergent low as well. This is, again, 1-minute charts. You're looking, this was Friday's low about midday. You had positive divergence on that 1-minute chart. So, a little counter trend bounce was likely. They ran it back to almost exactly. This was the close from Thursday. So that was flat. We closed ever so slightly negative, but it to me, and I've been trading a long time, it was the end of the month, last trading day of the month. So I have very little doubt that it was largely, if not exclusively, due to, I don't want to call it market manipulation, but there is it's been a huge proliferation of those, what do they call them, binary options. Binary options, you're just betting on a red or green close. And everybody, the speculators, this market has become a casino like I haven't seen, and honest to God, I haven't seen since 2000. This market is becoming more and more reminiscent of 2000. Obviously, the players and the names and the bubble theme is changed in some areas, but AI is the internet back then. Remember, if you were alive and in this stuff back then, you know what I'm talking about. They were, the internet was going to change the world, and it did, right? It did, but it didn't right away. Anything that had .com on the end, think pets.com, anything, were just flying, and they were going up just like these AI. Anything now, if you whisper AI, your company, I don't care if you sell Persian rugs, if you put AI in there and your quarterly earnings report, mention it, the stock's going to go flying up. And so we're seeing the same kind of thing. And again, I've talked about it many times. AI is nothing new at all. It's new to the vast majority of the public. They think it's a new thing. It's been around, it's just different iterations, and these LLMs were kind of set it off. When ChatGPT came out, and so that's it. And so the money that Google and Alphabet and Microsoft, which I read are like the vast majority of NVIDIA's business, that's real. They're plowing it in, but they're not seeing the ROI yet. And the market is making a huge bet, or investors are, that they're going to see positive return on investment on all that stuff. We'll see, guys. Time will tell. But again, my point being, it's not just like back then with the .com bubble and all those companies, anything with .com. Most of them, the vast majority, didn't realize the returns, and they went poof. Some were around, some evolved. but a lot went away. And I'm seeing that, and that's evidence. If you woke up this morning, I actually saw it last night. Somebody started texting me things. I got somebody I know that follows the crap stocks and meme stocks, and he's all into social media and tweeting, showing what's going on there. And I don't have it in front of me. I forget the guy's name. If it was on CNBC this morning, I turned it on to hear the economic releases, and they were talking about it. Anyway, he's the guy. Again, I don't remember the name because I don't care about this stuff. That was considered the driver of the original short squeeze on GameStop or AMC. I think it was GameStop, and then he went dark after that whole thing. He's been dark for a couple of years, and then started tweeting or posting or whatever last night that he took a big position in GameStop, and the stock was up. Let's see, in pre-market, just from one person tweeting that he took a big position, which of course is unsubstantiated. If you saw it on the internet, it's got to be real, right? So who knows if the guy has this type of position or not? And even if he does, it's probably the ultimate pump and dump scheme, because when you're that big and the whole community hangs on everything you say. I'm trying to put on the see where we went. So at some point this morning, GameStop was up 106% in the pre-market session, and then the gains of that. If you bought that, if you were the sucker that bought that 106% pop, you lost half your money already. Now the stock is still up, but my point is, this is a casino. This is speculation. These the Reddit traders targeting stocks with not just bad fundamentals, but abysmal fundamentals, no fundamentals really, and just simply tweeting out, and they're going to try to engineer a short squeeze or whatever. So let me turn these markers off. I just wanted to mention that, and again, it plays into what I'm seeing, the speculation, and with .com, there were companies, and it was a great buying opportunity back in 2000, 2001. The bear market ended in 2002, but if you were selective and you picked up the Cisco's of the world, and and the companies, the tech companies and the Microsofts and all those, then guess what? Then you did well. So, but the problem is when you get this group of traders, and please, and I mean no offense to anyone that's doing this, but in the investing world, it's called the dumb money and smart money, and the folks on Reddit, the moderators and Wall Street Bets, they were even put out a memo to please tell this person to stop. When you did it last time, you left a lot of bag holders, and we're talking back in 2021. All the people that don't really know what they're doing and heard about it here and then started buying in here, and you can see volume says that's most of the people bought here, and then they ended up losing as much as from there the stock dropped 92%. That's almost all your money. If you go down 92%, guess how much you have to make to break even? 1,200% roughly. That's what it shows there. That's how that works. So anyway, that's that, and of course, because GameStop getting pumped, they pumped AMC. So I didn't want to spend too much time on them. But you can see that that's what's in play now, and that is, again, the hallmark of a market top. You want proof? This is not my opinion. I've been doing this a long time, but when did this happen in AMC? 2021. When did it pop? When did it end? Ended in June. When did the NASDAQ peak? November 2021, a few months later. GameStop as well. And so it just phase two here. So we're seeing that speculative bubble, no different from what we've seen. We know there's a high engagement of retail traders, and I wanted to speak to that. And it's hard to predict when those things end, but we just know it's a hallmark, a signature that's been stamped on many bull markets in the past. And you can go back to the South Seas bubble if you want, all the way back as far as you want to go. So that's that. So we'll watch the technicals, let that be our guide. You don't want to get in front of one of these kind of bubble things until you're sure it's over. But again, it's just showing late stage action here right now. Okay, let's see. I covered that. I covered the meme stocks. Let's talk bonds real quick. TLT. Let's go to the 60-minute chart. So we're back to the downtrend line right now on TLT right there. This is a major downtrend line. Remember, when TLT goes up, rates are falling. And when they go down, rates are rising. So this is a channel, a price channel TLT has been in. And if you look at TYX, which is the yield of the 30-year bond, so it's TLT in reverse, you can see likewise that we're at the bottom of this. This is the channel. There's a long-term trend line here that was broken, and we've been walking up. And so that's it. So I cannot promise you where this is going to go, but what I can promise you and tell you definitively is where yields have fallen to support, and yields have been in an uptrend, and support is support until unless broken. So this, if we bounce here and yields go up and the bonds pull back, remember TLT is at comparable downturn line resistance, it's just turning this upside down, then that's going to be net bearish for the stock market. If yields break down and move lower, well, yes and no. So today you saw, the ISM, the bond yields spiked at, or bond prices spiked this morning right here at 10 a.m. when ISM was released. It came in weak. It's contractionary, continues to be contractionary. Consensus was 49.8. Anything above 50 is expansionary. Anything under 50 is considered contractionary. The consensus range was 48.8 to 50.1. It came in below, slightly below the bottom of the consensus range. And as you can read about it, go to I love this economic counter. If you're new to this, you're trying to learn fundamentals, and they have a little section under each report, why investors care. They explain what it's all about and basically tell you right there that when the GDP comes in weak, hot, you'll see bonds weak, below expectations, you'll see bonds rally, and that's exactly what happened. Yeah, it tells you down here the bond market will rally when the ISM is weaker than expected, and that's what happened today. So now, and this is what I wanted to get this is why I do these videos, get a little bit nitty gritty into this. So we are seeing, we can look at TLT, the price of the bonds. Let's just go to the 60-minute chart. We'll see TLT is up a healthy 1.26. That's a pretty good move. That's the 30-year. The 10-year is up 0.36, still in my orange zone, but a pretty nice lift. And so when you look at TLT and IEF, the 7 and the 10 and 30-year are up today. What stands out to me is junk bonds actually being down. I've got different charting platforms, and one is showing it up. Maybe it's adjusting for dividend. Most show it down today. Either way, this is JNK. I'm going to move that box over. That was a trading range there. It was on the daily earlier. I didn't notice. So we're in that bottom of that range. But so what I'm going to show you here, let's just jump over and let me get right to it. Let me park this volume indicator right now. Give us a little more real estate. Type in TLT. So what I have here is I'm on an hourly chart just to show you. I wanted to zoom down to correlation. So in green is JNK. That's one of the two big junk bond ETFs. LQD is the other. They mirror each other almost. I actually have 3 junk bond ETFs on my watch list. But TLT is, again, investment grade treasury bonds. We can look at TLT or we can do IEF. And what I'm going to show you, if you'll just bear with me here, we'll zoom in, how they move in lockstep. Now remember, you might say, well, Randy, these lines are not overlapping. They're two different securities with two different prices. They're different price scales. They're different securities. So if I set to start at the same point, it'd be closer, but they're going to separate because, again, they're not the same exact thing. They're different things with different prices. But when you look at correlations, you want to look, is one going up while the other is going up? And then when they turn, do they both go down? And you can do it yourself. You can overlay anything with any charting platform. You will see literally virtually zero deviation on the correlation here. These guys have been moving in lockstep, and I've commented on this. And again, in my years of experience, I haven't seen, I think one of the biggest risks to the markets right now overall is the mispricing of risk. Credit spreads are pricing in for perfection right now. And credit spreads, for those not familiar, the difference of what investment grade quality, no risk-free treasury bonds are paying, and what the low end of the investment grade spectrum, which we call junk bonds, there are still companies that are around, they're paying, but they're on the verge of, they get knocked down another, one bad quarter, two bad quarters, they run out of cash and they stop paying interest on their bonds. They can even declare bankruptcy. Those are junk bonds. They're just companies that are, and so we've seen just a super tight correlation for a long time now. And I'm going to say this, one day doesn't make a trend, but this is the only time, and you can do this yourself, that I've seen we're going different ways. I'm seeing treasuries up today and junk bonds down. So that is a change of character. And again, let me repeat this. One day doesn't make a trend. So I'm pointing this out, and it's something to monitor going forward. You can also compare it to IEF. I'm looking at TLT here, IEF, the 10-year, same thing. You're seeing the same super tight correlation between IEF and JNK going back without any deviation for as long as I'm scrolling back here. I can do on the 60-minute time frame, except this. And again, I looked at LQD is actually the government, the investment grade corporate bonds, and even there I'm seeing that. And this is where I think, again, risk is mispriced too on the investment grade corporates, because most of those are triple B. The vast majority of issuance in recent years has been triple B, which is unusual, meaning triple B is one notch away, one downgrade. If you're a company and you have a triple B credit rating and you get downgraded to double B, then you're considered technically junk. And what happens, there's a cascading effect. So this is a risk that I don't think is ever being talked about out there. That all of a sudden, if the economy starts to turn quicker than most think, everyone's talking hunky-dory right now, 2024, well into 2025. I even hear some, semi-perma bears talking, oh yeah, we're okay, recession's coming, but it's going to be in 2025. Well, hey, maybe. But if things turn quick and the market has a way of doing that, and then you start seeing these downgrades, it's a domino effect, because investment grade corporate bond funds, by perspective, if I'm a manager and I run a investment grade bond fund, by prospectus, I can't hold junk. So, and these things get downgraded. What happens? I have to sell them, and every other bond fund manager that has that, directive must sell them. And you're going to see a lot of selling at the same time out of those newly, downgraded, formerly investment grade bonds now to junk bonds. So that's one risk. So we're going to watch this, and I'll continue to monitor it and see if it's not just a one-day aberration. I clicked over just back to my regular daily chart because I had LQD queued up, and this chart's busier than a one-arm painter, but it shows you my levels, and I have LQD at downtrend line resistance right now. Forget about the purple box. The purple boxes just show that it's also when the PPO is below zero, you tend to be in a bear trend, a downtrend, like here, here, and here, and here. And so if the PPO gets rejected here, it's going to keep this downtrend going, and this means investment grade bonds down, which means rates up. So again, today we're seeing bonds, treasuries rally with bond yields falling, but again, that's more indicative of these economic reports. We're reaching that point, I think, where the stock market's starting to say, yeah, that's a flight to safety bid in treasuries. That's why I spent that whole time explaining to you that this abatement in yields right now on face value might seem appealing to stock traders, but yet why you should see yields on junk bonds and investment grade corporates coming down as well, and you're not. So that's, again, we'll watch that. I noticed some flash crashes today. Somebody sent me something on Berkshire A. I don't know if they fixed it yet. You can see this is the stock. There were a couple of them, actually. They don't know why it happened. They're trying to fix it. So you're looking at Berkshire A is the Buffett's company, a B and A. Most people buy B because Berk A is 625,000 a share was until it hit plunged today to 174,000, down 99%. And I looked at the 1 minute chart, and you can see it got a little wonky before that happened. You started to see some volatility. So this is the thing. The machine's gone wild, is what I see in this market. Algos, all this electronic trading, these speculators playing with these short-term options. with usually hours to go in expiration. I'm trying to zoom into the 1 minute so you can see. I did this early. It's hard to move because once it had that drop off, it just flash crashed down to near zero. And but this was so today. Here you go, right here, as best I can do it. You could see the volume was spiking, started to go down, was getting choppy. Something was happening to Berkshire A, and then again it just dropped down to nothing. Same thing with Bank of Montreal. Yeah, BMO. You can see again. This is what it looks like. It just crashed to next to nothing, and I guess I don't know if they're gonna. They'll go in and they usually figure out they'll undo some of the trades, I guess. But it's just it's hey, what's happening here? That's all. Sometimes these things happen and it turns out to be nothing, but sometimes it turns out it's kind of like a shot across the bow. So again, it's another thing to monitor. If you're in the stock, I don't know to tell you. I'm sure you'll get something from your broker soon what they're going to do about it. I'm trying to zoom in. I wanted to zoom in real close if I could this morning, so you can see. Again, you started to see some selling, some volatility, and then that's just when it popped off. And then there's another one. These are the two that somebody sent me. There was a tweet that they knew those two did a hard crash. But then I was looking at the semis, and XSD seemed to have an unusually large spike compared to the sector as a whole. So there's a 1 minute chart. Look at this. So something happened after the open. In just 1 second, it dropped down, almost 5.5%, and then snapped back up. So there's what I call these errant prints. I don't know if there's an actual name for it. When you see a print way away from the price, usually you see that in the after-hour session. So I don't know. Just be careful, guys. The machines are getting a little wonky here, and T2 Judgment Day. I don't know. I'm just playing around with you. It's again, like at any point in time, you should never be so exposed to any one stock or any too heavy in anything that it's going to wipe you out. But I just wanted to bring those up, and now and I found that by looking at the semis. Remember, there's that XSD. That's probably the most accurate of the semiconductor sector, and that one still has not reached its 2021 high. So it shows you, again, it's the magnificent one. It's pretty much about there. It almost equaled the previous highs right there. I'm going to put a line up. Again, this was 2021 when it peaked. So it's all about the magnificent one, which is NVIDIA. The rest of the semis, they're in an uptrend, but they've just, they finally regained all the ground they lost over 2.5 years. And then they just recently broke down, so it's a double top high is what it is at this point in time. It's not a breakout to new highs, as a double top high in the semis with the PPO poised to make a bearish crossover. Remember, we just got that on the NASDAQ 100 the other day. It's a good indicator for trends. When you look at, throw up the histogram and you'll see what I'm talking about. PPO histogram. It's these big green and red hills. When I say big, that's a small hill. These are the big hills right here. These hills like this. And they tend to do a pretty good job of showing you trend changes. So there was a green hill. The trend was bullish. If I circle that, right, you want to be long and strong in the green hills. And there's a red hill. And the trend was, clearly bearish, sharp drop off there. Red hill, big down during that red hill. Big green hill, and that's the thing about the PPO histogram. It often acts as support or resistance. If you test, and it held successfully, kept the trend bullish this whole time right here, and that was the biggest trend that we had. So if you're a swing trader and you're trading, incorporate these into your trading. It's not a standalone buy and sell thing. You missed all this choppiness. You went back, it would have drove you crazy as a swing trader. You probably would have been stopped out and back in 10 times over. So semis eventually grinded a little higher from this point, but then they put in a divergent high, and then that happened. But again, there's a clean big hill right there, solid strong trend. We're mostly red throughout this period, with a few counter trend rallies, which were marked by those green hills. So where am I going? We haven't crossed yet, but we're poised to. The PPO is crossing down, about to cross over. The histogram's at 0.09, which means any more downside from here, we'll get a bearish crossover, and that may begin a new trend. But we already have a sell signal. We had a breakdown here recently after divergent highs, so that put the semis on a sell signal, just like SOXX, which I've covered recently more often. There was your bearish engulfing candle. There was that little pop stop marginal, ever so slightly new high. We had a bearish engulfing there, and pretty much again, it's the same story. It's a double top high, or even more bearish if you want to look at it that way. A failed breakout. Like I say, the only thing more bearish than a rejection at resistance is a break above that resistance, followed by a failure, because then that's a bull trap. Shorts get squeezed out, longs pile in on the breakout, and then they realize the breakout failed. And so that's a net bearish event. But, we're still not too far below there. There is another. So it must have been a single semi, because I can see it here on SOXX too, that little, today, that little swoon down. Maybe. No, I'm sorry. That was Friday. That happened in SOXX. There was that swift. Oh, yeah, because a big reversal on Friday. Anyways, there's your update on the semis. No, nothing's changed from my outlook. Nothing's changed in the market. We're below the bearish engulfing candles. There's just not a lot. I know I'm talking a lot about different things here, but in the charts, there's not much to see or do today. You did have, I showed you earlier, you could see I didn't talk about it, but that was Friday's low when we had the reversal. We went up. There's some resistance there. We hit today. We also put in another divergent low today. Had a little rally. These are your resistance levels if you're a very short-term active trader to watch for on the 1 minute chart. If you go to the 15-minute chart, there is that downtrend line. We had a brief at the open, order imbalance, opening pop, fell right back below it. So we're back below the downtrend line off the recent highs. And this is still, again, to reiterate, the level we hit and bounced off. That was from, the targets I had last week when we hit this trend line. Every time I draw, I think you know this, I say it all the time, when I draw my arrow breaks are where you're going to have a reaction. I don't draw every, counter trend rallies anymore. I used to, sometimes I will if I have strong convictions to where it's going to go, but arrow breaks to note where a reaction's likely, and that's it. So the next leg down, the next sell signal should come on a break of that trend line, and the levels on NQ as well. There's a 5-minute chart of NQ, divergent high today at the highs, and followed by the rejection right there. Okay, and I'll wrap this up covering the commodities. Remember, I've been talking about this for weeks, a couple months now, a few weeks back, that natural gas has been trading when we went long. Recently, at the bottom of a, pretty much its trading range. This is natural gas. Again, it doesn't go to zero. It doesn't commit corporate fraud or embezzlement. Doesn't file for Chapter 11 bankruptcy. The current administration may be trying their damnedest to get away from fossil fuels, but they're here to stay. Just to digress, you can already see that in the EV market. Prices of Teslas are crashing. My wife has a company car. It's a Volvo SUV hybrid. This is one of the nicest cars I've ever driven. And that's where I think things are going. A plug-in hybrid. You got a gas engine. The thing's a rocket running on gas. She never even plugs it in. And I'm sure on electric, so you have the best of both worlds. That's where I think the car market's going. And so I think fossil fuels are here to stay. I think people are realizing the electric cars, for the right person, if you're short commutes, great. But, you want to jump on the road and drive across the state like I'm about to do. There's nothing in the middle. You cross from the west coast of Florida. As soon as you leave Naples, you get on Alligator Alley. They call it Alligator Alley because you're crossing the Everglades. There's literally one gas station between, and that's closer to the East Coast. So my point is, you get getting a Tesla there, and your battery runs out. You're gonna sit on the side of the road in the swamp. And I don't know, I guess they have to tow you in because they can't bring you gas. So anyways, again, fossil fuels, you can't write them off yet. And again, you can have them. That was a fundamental ramp, but technicals are what I trade off of. And that's it. So I look for these divergent lows, divergent lows, divergent lows. And I'm going over this because I like to revisit from time to time the nature of natural gas. When it finally picks a bottom and the trend changes, it's pretty powerful. And it's not straight up. I know you can't see this drawing tool with this color. There's going to be little zigzags along the way. And that's what we did. We were low right in here off the lows. We milked up that 50-something% run, sidestepped it, and then just got back in recently. And again, to me, what I'm seeing here, this was big divergence at that long-term support. Much bigger than this divergence here that gave us that. and even bigger than this divergence there, comparable but a little bigger, that gave us that, and ultimately that up to there, really. And so, yeah, I think there's more upside in that gas. And let me get the chart for you. And so that's it. I saw a question somebody asked, hey, thanks, I sold it this morning, where to re-enter? At this point, we just broke out. So you could have bought that pullback today. There's minor support there. This is that divergent low. We were buying it here. We caught most of that 50% run. T4 was hit there. So I mentioned, sidestepping, getting out. But it was the final near-term target. Gave you a longer-term target, which is still in play. But those futures have rolled. We're on the Julys now. We started out with the May, and then we went into the Junes. And so this was it. That was a correction I was looking for. Gained a little bit of it on the short side, pull back. And there was that beautiful bullish falling wedge with positive divergence at the low. We just broke out. So, that's the next target, 285-ish, 296-ish, and then so forth. And so the arrow breaks had it going like that. So, and now where to? This was recently where we pulled back. That was the bottom of that wedge. There was our breakout point. Your stops will be dependent on where you are in this. But at this point in time, it'd be ideal, just optimal to see it stay above 250. If it drops below there, I'll give you my 2 cents. But as of now, it still looks good. And I'll give you UNG. If you need targets on UNG, let me know. But as I always put on my UNG charts, and I always say, best to align entries and exits on UNG with natural gas. And so there was that previous UNG targets, and there was a downtrend line hit, and there was that recent breakout, and there we are. Crude is really stretching the upper limits of what I want to see. So crude, remember, we went long on this trend line. I'll pull back to the trend line. We started scaling there. That was my optimal entry point. Then we took out the trend line, but I said we had some price support here, and we still had at the time the positive divergence. So we hit the trend line. We hit multiple targets, and we hit this downtrend line. Then we took out that downtrend line. The first bad sign recently is a failure of this trend line when we took that out. Now, I want to say this. If you took it here, we're only about 2%, I think, below where that initial entry point was. And again, most active traders trading futures have probably already booked profits there, tried to buy back in lower. It's almost 3%, close, about 2.8% right now, below the entry point here, that entry point on the trend line. So if you're taking it there and you're looking for, a big move up, more upside, here's the thing. I wouldn't buy it here. If you did that and you're a longer-term swing trader, you might want to sit tight, give it a little room, because we're by the skin of our teeth. We've got pretty much equal lows on the indicators now, lower lows on prices, which means you have positive divergence. This price action, the failure here of this break out of that downtrend line was bad, and then this break above 76.30, 76.36, which was all these recent lows right here, here. There was one right there before we broke down. So I can't spin that as anything but bearish. So if you're still in crude, I wouldn't give it much more room, much more downside. It's going to take out divergences. I don't see a lot of support here on the futures, and can't make a case to buy it. The only way I would add to it or buy it is if we recover, and I think that would be a quite bullish to regain 76.36 here. Again, this recent support level, that would most likely rocket it back up. This whole thing will prove to be a whipsaw, aka bear trap. Let me see what it looks like on USO if I have that marked up. USO. USO, same thing. It's hanging in there by the skin of its teeth with that divergent low. We had a divergent low back here. Remember, that's where we bought on the trend line right there. Bounced up, had a decent run, nothing great, but about 5% rally up to this point. But then it broke this trend line here, took out the recent lows. It is close enough. I had a support level there. It's decent. It's not great support. So again, that's it. To reiterate, I wouldn't buy it now. I'd wait till it reverses and shows me something else. It keeps these divergences intact. And takes out the recent lows. You can see it's not as well defined, because remember, USO, just like UNG, this is an ETN that tracks the price. It's tracking the futures, but it doesn't do as good a job, and it only trades 9:30 to 4. Futures are trading around the clock, so you want to see that level regained on the futures. So there's my update on on crude oil. And keep in mind, crude oil and natural gas can often do their own things. One can be going up and the other's going down. You see that quite a bit. In fact, when they turn on the pumps, pumping crude, natural gas coming out as a byproduct, and so that kind of can bring the price down. But again, they're going to march to their own drumbeat, and I trade them independent based on their own technicals, not in sync, or not necessarily. Sometimes I'll be long or short both, but it's only if the charts tell me to. Wheat, I told you I'm sidestepping the grains. Just wasn't feeling it. Waiting to get back in. They're right where we, sold out, or I sold out. I told you we hit T3. We've just been stalling out, and it's somewhat healthy so far. It's working off those negative divergences more so in a correction of time than in price. Longer term, I remain bullish. This was T2 right here, hit, and again, we've just been consolidating. Very, very overbought. And so that might be a little more consolidation needed. Maybe we need to pull back to T1. I don't know. But I think, look, now I can tell you. You look here and you can see I'm going to put a little line. I'll just put it with a trend line like this. These recent highs, so this little trading range I just had boxed in, that'll probably do the trick. When we pop that, that'll probably open the door to T3 and quite likely T4 and then maybe T5. I still maintain those targets. I'm just not sure near term. We need to pull back a little more, work off these extreme overbought conditions a little more, and if so, then I'll probably be a buyer down here if it retests that key. That's a big level to me, that $6 former resistance, now support level. And corn and soybeans are roughly going to move in line with it, so I'm not even going to bother updating those two. I have recently. Corn is CORN. Where did it go? CORN. That one's actually pulled back a little more. So yeah, T1 hit, and then soybeans holding up right now. Oh no, that's SPY, SOYB. Close. Oh, look at that rejection. Oh, I didn't even realize they'd come back in so much. These two, and thank God I'm out of them. But that's it. That's support right there. So soybeans might be interested. Let me look at the futures real quick. It's a shame it didn't hold this level. So we had that, when T2 was hit, we had that bearish rising wedge. I probably would have covered this at the time. That's one reason I'm out. Bearish rising wedge with negative divergence, just like the reason for going long was this bullish falling wedge with positive divergence. Became that uptrend, and we broke down. We've been all these former price targets on the way up. Or at least this one we hit, we bounced, then we hit this next one, which I had here before. We bounced, minor reactions, but we're below it. Just eyeballing this chart, there is some minor resistance right about where we are. Why did I put it there? And I just didn't pick a random line. There, some reactions there. It really needs to hold here. You had some divergence, but it's ever so slightly been taken out. So I'm just going to stand aside for the time being again. I'll wait for a re-entry, and I'll try to update you again in the next couple of days. Like I said, I'll be a little bit away from my desk on Wednesday. Maybe the whole day Wednesday. I'm not sure yet, but I'll be around tomorrow morning. If anything changes, I'll let you know. Okay, guys, I'm going to wrap it up there. That's it. So like I said, I'm kind of more in swing trading mode, and it's a function of what I'm seeing and not seeing in the intraday charts, but also my schedule in the next couple of days here. I don't want to get too involved, too heavy in anything when I'm traveling and doing stuff. So again, I will be around throughout today. Might cut out early, to be honest with you, and then back in tomorrow. If I see anything before I leave town, I'll get it out to you. And if I don't get to you on Wednesday, I'll be back home Wednesday night at the latest, and I'll get something out if there's anything significant to note. Other than that, just QQQ and SPY, watch those highs. We're below those bearish engulfings. So until proven otherwise, I'm treating those as likely and potential topping sticks. So for, good trend and short entries, and we're not far below them now. If you happen to believe it, or want to take a shot, again, it's not what you believe. It's what's your trading style. If you're at times, I told you I'm somewhat mechanical, and other times I'm not. I'll override certain things I see if I suspect it doesn't smell right or feel right. But with these bearish engulfing candles, short them. short anywhere near them with stop somewhat above, and if and target the 200-day moving averages. I've followed up here because this one, despite Nvidia still doing what Nvidia does, because it's the Mag 1 now, everything's piling into that, the king of all things AI. This little guy was following it, lockstep. It was this little partner in crime, and I just wanted to point out, because I told you I would keep up on it. It's still a short trade idea. Broke this uptrend line the other day, and it's been moving lower, and it's currently back testing this downtrend line. So if it fails that, then that's bearish, because the bulls should be, if you turn off all my other lines and look at it this way, this is what bullish folks see. And I recognize it. And a downtrend line, where is it, like that? A breakout on big volume, big green candle, and a back test. So for those that are bullish, whether you're listening to my voice or I'm speaking, hypothetically, this is where you should step in and buy right there, right? And you also have an uptrend line as well. And that's what, if the stock is going to new highs, is where, the buyer should, quote unquote, step in. But if they don't, then that's kind of bearish. And that's kind of what we've been seeing. We keep getting these little divergent lows on the 5, 15-minute charts on the NASDAQ 100 since those bearish engulfing candles. We start to rally and boom, it gets sold into. And so the big level to me is still 690 right there. When that yellow line goes, it's lights out, and that's going to take us to my sold price target down there, 355, which I laid out all the way back. Oh, here. That's when I first shorted it and then covered it once, got back in. But anyways, that's... I think I just want to point that out because it's not following Nvidia up to new highs anymore, and it's showing, and nor is the whole semiconductor sector. Again, the SOX, SXD, it's just Nvidia right now for the most part. SMH is another semiconductor ETF right there, big divergent high right there on SMH. And then to end it here, because I meant to cover it earlier, the VIX. Just remember, the VIX is coming off that long-term support zone, big divergent low, started to move up. It's still, I wouldn't call the VIX elevated, but the technical posture is bullish, and we're still up a little bit. So that's why you saw the big reversal. And the VIX was up big last week. And so volatility, remember, volatility doesn't mean stocks, doesn't just mean only down. Volatility means big swings in either direction. And when the VIX starts to move up, that's when you get volatility. The drops are bigger and swifter, as are the counter trend bounces and rallies, just like you saw on Friday, that big reversal. So that is indicative of elevated VIX, or a VIX that's starting to move up. And so now at this point, you want to see the VIX obviously take out, if you're bearish, take out last week's highs. We backtest this trend line here. You want to see that get taken out, and then this yellow level, and I'll still maintain we're going to go up. And if we hit my targets on QQQ, that T4, T5, 3 area where the 200-day moving averages are, that's going to take the VIX up and probably most likely take out these October highs right there. We're going to see a big move up in the VIX. So a lot of potential, but that potential is contingent on the stock market continuing lower to see the VIX do that. I will wrap it up here. This has been Randy Finney with the Right Side of the Chart. Have a great day.